Recording now. So we're recording. So you guys don't want your recording to be shown, just, cover your camera. I am recording this so that I can then share it out with you guys afterwards in case you missed something or you wanted to do a recap. All the presentations, both the links that I'm sharing with you and then the links that Jay is going to be sharing with you and the PowerPoint will be sent out to you after this. And I am going to share with you guys my screen so now you can see what we're working on today. Okay, perfect. So, perfect. Can everybody see my screen? Feels like it's loading, but
yes,
it's black now, but okay. It's easier doing it this way. Perfect. So welcome to today's stand up. We're doing this on a daily basis just to kind of get, get you guys going for your day. We're going to be covering different topics. A lot of these topics revolve around, how to pivot or how to make sure you guys are adjusting to this current status. We obviously don't know how long this is going to last, so we want to make sure you guys have access to all the information and resources as you guys go through your day. And as you guys know, we already operate as a virtual incubator, which means a lot of us are, working remotely. Most of you meet with your advisor on a remote basis, whether it's via call, Zoom. Sometimes you do it in person. Sometimes we do it at co-working day. But we want to make sure that we continue to, work on your business and we support you in any way we can. So we decided to add on these VIXL morning stand-ups with different topics to make sure that you guys are getting all the support that you need. So top 3. So updates, the team. So Emily and Kat are both on here so you guys can see it. We are all working remotely as well as the entire chamber team. So we are working remotely until, as of right now, we know that we will be working remotely until the middle of April. Obviously, as things change every day, we might get, different notices and or they'll tell us if this is going to get extended. We don't know. I think a lot of us are kind of in this phase of like, we're just taking it one day at a time. We do get updates every day to see kind of what the status is around the city, around the state, and around the federal government. So as Kat mentions, or she might mention later, we're on about 2 to 3 hour calls every day, getting updates on the money that's coming down to support companies, any kind of updates around employment and all of these different things that are kind of happening at the local level. So right now we're working to see if there's going to be any additional like grants that are coming out, any loans that are coming from the federal level, and any technical assistance that is going to be provided by the state. So in terms of unemployment and things like that. So we'll keep you guys updated, and anything that we think it's relevant to you guys, we'll make sure we pass it on. Slack is the best way to kind of get a hold of us. So if you guys haven't joined the Slack channel yet, please do so. Take a screenshot of this of this top 3 so you guys have the link. Thank you to Scotty for hacking a smaller link so you automatically can join in. This Slack channel is not my Slack channel, it's your Slack channel, and it's actually moderated by, well, not moderated, but it's actually was created by like two founders, Scotty, who most of you guys know from Foodies.ai, and I want to say it was Lauren, Yolanda, I don't know. Anyway, but it was created by you guys, and you guys are the ones that are kind of putting stuff up there. I just joined, and I always just drop updates and things that we find out. So at the end of this webinar, in addition to the PowerPoint and the presentation, I'm going to send you guys a survey. Please fill it out. It is very important that you guys fill out the survey because this is the way that we get our funding from, right? So in order for us to continue to operate, that feedback in that survey is really important. It's about 5 questions, so it takes like 30 seconds to do. And also we want to hear what you think about these morning stand-ups and if there's anything that we need to be changing or adjusting, better timings, topics, I don't know, whatever you think. So let's see. Okay, so before we go into this one, I want to say thank you everybody for joining us this morning. If you guys have any questions, again, Slack is the fastest way to kind of get a hold of us. but you can also email us. So
Elaine,
yep.
Can you move, I think your screen froze. Will you move it to the second slide so folks can see the Slack? Thank you.
Can you see the second slide?
I don't think it's coming up. I'm not seeing it on my end, so no, I'm on the chat. People are not seeing it on the chat as well.
Yeah.
Okay, let's see. Let me try this one more time.
Thanks, Elaine.
How about now?
Can folks see that?
Yeah. So here's the Slack channel.
Yes, thank you.
Perfect. So here's the Slack channel. And then before we go into this, I want to say thank you for everybody for coming. If you guys need to get a hold of us, here's our emails. So mine, Emily's, and Kat's.
Sorry, we were still trying to write down or do the side channel. Thank you. Okay, got it.
Also, I'll drop this link too in the chat so that you guys can also access it. And I'll drop in the emails as well. I will say, I think Emily and I are better on email, and then I think Kat responds to Slacks better, and or LinkedIn. So if you don't have her on LinkedIn, add her on LinkedIn. Those communication preferences. Okay, awesome. So we're gonna move on to the webinar, and so I'm gonna pass it on to Jay. Let me. Okay.
Jay's muted.
Let's see, Jay, we can't hear you. Can you unmute yourself?
Guys, how you guys doing?
There we go.
Top of the morning to you. Happy Tuesday. Thank you guys for joining in. We're talking about a sensitive topic today, but I kind of want to make this collaborative in nature rather than you hearing me spew all this, all this information. I want this to be collaborative in nature. I want you guys to share some of your experiences, and hopefully we can all learn from each other. So today we're going to talk about financial planning in the type of crisis. Okay. I'm sure you guys are trying to figure out how to navigate what's going on in the environment today. Obviously dealing with the crisis. I myself lead a couple companies, and I'm in the trenches just like you guys, dealing with fundraising, dealing with managing burn and cash flow issues. So I thought it was apropos today to address and bring out some of the relevant topics that I'm sure you guys are dealing with. And talking about what's going on in the financial climate, what's going on with fundraising outlook, etc. And so let's hop right in. I'm going to share my screen here. Give me a second. I didn't want to get really formal with the whole deck and whatnot, but all right. So financial planning in a time of crisis. How did the stock market do today? You good? Well, we're up almost 2,000 points. But all in all, we know that there's some doom and gloom out there. Stock market is tumbling. We're seeing, massive adjustments out there. And this is freaking out the market, right? The proverbial, fit has hit the shan is kind of what the sentiment is out there. I'm sure you guys are all asking, is the stock market crash going to be spooking investors? Are investors now sitting on the sidelines? Is the financial world coming to an end? Obviously, everyone's, staying at home, social distancing, focusing on, the 24-hour news cycle, gluing their eyes to social media and their smartphones. And so you're bombarded with all this news, right? News about the coronavirus, news about, fatality rates, and then also looking at the financial markets, you can't help but see that the sky is falling. Who's engaged right now in fundraising activity for their company? We all are, yeah, to some degree. So let's talk about the fundraising outlook. What's in investors' minds? What market implications exist? And I'm gonna do this. Hold on a second. Okay, so what's going on in the market today? So obviously there's a healthcare crisis, massive amounts of volatility, a lot of unknowns, and obviously unknowns spook the market, right? People out of work. This is the end of the longest bull run in recent history. So we've seen definitely a greater than a 10-year upcycle during this run. And everyone's been speculating over the last, I would say, 3-4 years, when's the market correction coming? When's the market correction coming? No one anticipated that, the impending epidemic and healthcare crisis is what kind of exacerbated it, right? And so we're seeing recessionary forces come into play due to government mandates. And what does that mean? Normally, during an economic downturn, the 2008 crisis, the stock bust in 2000, 84, the various different cycles that we've seen, it's always due to some sort of economic activity, some sort of, asset bubble burst, some sort of, economic indicator that has eroded. In this particular case, we're dealing with something obviously that is affecting, everyone's health. And the impending recessionary forces are coming from the government themselves telling people not go to work, right? Generally, the economy has relatively been pretty healthy. The stock market was, breaking records on a daily basis. Earnings, we're seeing record amount of earnings. The cash trough was huge for a lot of companies. Hiring, unemployment was very low. Consumer confidence was very high. And then all of a sudden this hit. And the government is saying, stay at home, don't go outside, don't go to work. So it's exacerbated by government mandates. So we're seeing economic indicators, and we're going to see this throughout the coming cycle within 3 months, 6 months, 12 months, et cetera. We're going to start seeing earning reports, and the earnings are going to erode, right? Outside of the Costco's, outside of some niche players that have taken advantage of the market, we're going to see some, erosion in earnings, and that's going to spook the markets continuously. We're going to see unemployment spike. I was looking at reports saying unemployment numbers could be upwards of 40 to 50%, right? Not because of government not hiring, it's because, again, government mandates. In order to stop this pandemic from spreading, we need to distance ourselves, work remotely, and obviously that's going to affect productivity. Consumption patterns. What's patterns? Consumption patterns. That's what I meant. Consumption patterns. So we're going to see people, obviously, if they're not traveling, they're not buying things, they're not going outside, they're reducing their spending to staple items, food, things that, commodity items that people need to survive. Outside of that, people aren't spending money on luxury goods. People are going to be spending on things that they don't need. And then we're obviously going to be facing supply side shock. So if you're in a business in which you're producing anything, you're relying on third-party, suppliers or vendors or a supply chain, obviously that's being disrupted. I'm in e-commerce and I run a couple of consumer product companies, and we do a lot of overseas manufacturing. Obviously that's been affected, right? We rely on supply chains coming from Latin America, from Asia, and obviously Asia, what was going on with China, put a halt in things over the last couple of months. Things are getting back to normal. However, the ports are pretty much a ghost town, right? We're seeing 7 million containers missing a day. Almost 50% of longshoremen and the Port of Long Beach basically temporarily out of work. So we're seeing dramatic supply shocks. So what does this mean for fundraising, right? The show must go on. Investors who are in the business of investing money, they may have deployment mandates based on from their limited partners and LPs and their funds, et cetera. They have to continue to engage in activity. However, with the pending crisis, they're limited. So what are accelerators and incubators doing? Well, they're still open for applications. We know that Techstars, we know that Quake, we know a lot of the local accelerators are have opened up applications. We know that global accelerators are continuing to open up applications to their new cohorts. A lot of them are moving to remote, right? So we're seeing pre-accelerators, we're seeing pre-seed accelerators, and regular accelerators contemplate the idea of just running things remotely, not aggregating cohorts, especially in cities in which there's shelter in place, there's shelter at home, there's certain statutes that forbid people from gathering, greater than, crowds of gatherings more than 10 people. We will start seeing, deferment. So if you got accepted to an accelerator, they may allow you to defer to another cohort down the line. Postponements and cancellations are obviously very real. Family offices, they're most likely going to be reducing their investments, right? They're going to be focusing on their current portfolio companies. The winners that they have, the companies that they've invested in, they're going to make sure that they survive this crisis, right? So they're going to allocate a certain amount of their budget towards ensuring that they have sufficient cash flow and that they can continually support their runways. Angel investors. Angel investors are definitely the most risk-averse category in the investor community. They're going to be, if they're investing at all, they're going to be mainly focused on very high cash return opportunities, and they're probably we'll probably see less activity from the angels, except for those who are part of super angel groups like TCA, Pasadena Angels. Angel groups still may be active. However, you'll start seeing, venture partners or limited partners within these angel communities definitely more cautious. So let's talk about the state of venture capital. Everyone's wondering, okay, should I engage with, I have a CRM and, after the holidays, after the investor hiatus, this is a great time usually to start ramping up momentum around fundraising. Well, with this pending crisis, everyone's scratching their heads and wondering what's their prognosis, right? How do I engage with them, tastefully? So what I can say is this: there is going to be some slowdown. Obviously, everyone's cautious in this market, right? But venture investors still continue to invest in downturns. And here are some reasons why they continuously invest in downturns. Number one is that venture returns are largely uncorrelated with public markets. So regardless what's happening in the public markets, with the S&P, with the Dow Jones, there's statistics have shown that venture returns aren't correlated with the public markets. Yes, a lot of times large venture capital funds do accumulate a lot of their fresh powder from public markets. Okay, they potentially do syndicated investments, etc. However, the returns are greatly uncorrelated. So usually during a downturn, when recessionary forces are coming in, the public markets naturally are going to be trending downward. However, venture capital tends to be somewhat insulated. So that's one reason that they pay less attention to what's happening in the public markets. Okay. Number two is that venture is usually a liquid asset that has a 10-year horizon, right? So when a fund is put together by venture capital, they're looking over a payback period of time. The first 2-3 years, they're looking for deal acquisition. They're looking for deals. They're doing due diligence. They're deploying cash. And then within the next three years or so, they're looking at their existing portfolio. And then the last 3 years of the fund, they're pretty much sit and wait and seeing how their portfolio companies perform. They're engaging with their entrepreneurs. So because it's a long horizon, economic cycles tend to move upward and downward through this horizon. You may encounter a couple small down cycles, or one major down cycle. So venture capitalists are prepared for this type of volatility because their expectation for payback has such a long horizon. Unlike a public market investor who may be a day trader, they're looking for returns literally on a minute-by-minute basis, or they're looking at it from a day-by-day basis or a week-by-week basis. Venture is a liquid asset for the long term. Okay. Venture investments tend to be more impervious to market cycles. Like I said, because it's a longer horizon, they tend to go through and have more patience in terms of weathering the storm. Funds have deployment mandates. I talked about that. So there's a certain amount of funds that they're required by their LPs to deploy X amount of capital. So they're scouring for deals, right? They're looking for deals. A lot of venture capital have raised money during the upcycle, let's say over the last couple of years. So they've accumulated a trough of 10 million, 50 million, 100, $500 million of fresh powder that they're looking to deploy. So during an upcycle, especially when the public markets are healthy, a lot of venture capitalists are out there shaking the trees with their LPs, just like entrepreneurs are, in terms of raising money for their fund. So a lot of times they have this fresh powder when recessionary forces hit. So they have money to deploy. So how do they look at the market? How do they look at opportunity? So from a venture standpoint, economic crisis equal investment opportunity, right? So in this type of market, when there's a downturn, investors gain more leverage and choice, right? So they're still active because they know that there's going to be more available type of deal flow for them, okay? They may be able to implement more selective investment criteria, right? Because there's going to be a lot more deals chasing a lot less potential investors. They themselves, if they're active in the community, they themselves see it as an opportunity to be more selective with their criteria. They can make stricter policies, right? Obviously, they can probably negotiate. They see this as an opportunity to negotiate and deploy at lower valuations, right? So if there's less supply side and still a lot of demand side from entrepreneurs who need capital, entrepreneurs may be more flexible in terms of the valuations that they are more open to when it comes to accepting certain types of term sheets. Okay, VCs can access more private deals through syndication, right? So VCs work together; they co-invest with other venture firms, with other investment outfits, and so it's going to be richer and higher quality of deals out there for them to syndicate and leverage each other's capital to invest. And then lastly, winners become more visible in this environment, right? Those who can't survival of the fittest, those who can't survive in an economic downturn, they're pretty much going to whittle it out, right? Entrepreneurs who can't weather the storm, what are they going to do? They're probably going to shift gears. Lifestyle-wise, a lot of them may go back into corporate America. A lot of them may put their venture on hiatus or put the project on hiatus and go back looking for a full-time job, et cetera. And so those who can stick it through, those strong management teams, those strong projects are going to stand out. And therefore, it's going to be more visible for investors. So let's look at firms who've raised money or have come out or were incubated out of recessionary times. Huge firms came out of the depths of recessionary forces, right? IBM, GM, GE, HP. This was during the 50s and 60s, your recessionary forces. FedEx and Intel came in the 70s, right? They were incubated in the 70s. Microsoft, Southwest Airlines in the mid-70s to 80s. CNN, Symantec. Some of the largest companies, some of the largest blue chip companies were started literally in the depths of the recession, right? Let's look at within our tech space, right? From Phoenix to unicorns, Google and PayPal, they were started in the dot-com bust in the late 90s, 2000s, right? They literally resurrected themselves. Airbnb, Uber, Square, they were erected when? 07, 08, during the last, economic stagnation, right? These are companies that were literally built from the depths of recession. So can companies be built during this time? Absolutely. We've had some of the best companies in our history come out of these times. So therefore, this should be some signs of encouragement. So what do investors look for during a time of crisis? Number one, they always still strive to look for visionary projects, right? Visionary projects that stand out above the crowd, right? Visionary projects that that not only can weather the storm, but have long-term sustainability. Again, they always look for great, resilient founding teams, and in these particular teams, even more so. You know, we always say that investors don't invest in great projects or great ideas, right? They invest in great teams, because great teams can take a shitty project and pivot and make it into a winner, right? Crappy teams can take a great idea and completely decimate it, right? So, you know, I was talking with a couple managing directors at Mucker Labs, and they were, you know, they've invested in you know, some great companies in LA, it's ecosystem over the last few years, but a great win was Honey. If you guys know the story of Honey. Honey is you know, a local company that had a huge exit with PayPal a few months ago, and they were telling me the story of how, you know, they faced tremendous amount of headwinds and pending doom. They, you know, their initial versions of their product really kind of didn't stick. They kind of burned through their cash, and the founding team basically all went to find jobs. They all left. They disbanded the company, and they all basically got full-time jobs. And William Su, he's one of the managing directors at Mucker, basically brought them back and said, listen, we have a decent product here. We need to come back and just figure out how to strategically make this work. They all came back, put efforts, rebuilt the product, and unbeknownst to them, they had a, you know, multi-$100 billion, you know, what was it, $4 billion exit to PayPal. It was an amazing story. So, you know, companies go through these tough times, and the ones that are resilient, the teams that are resilient, they're the ones that you know, kind of cross the chasm. Investors always look for upside value appreciation. Obviously, they're looking for you know, projects that can potentially have, you know, upside. Steady and continued traction. If you're a project that even during tough times can show that you have steady traction, you can show that you have, you know, you have good, you know, customer and user engagement, that you can go out there and still acquire customers. You know, that obviously is showing that, you know, you're somewhat impervious to a crisis situation. And obviously, paying and committed customers, right? If customers are going to still continue to pay for your service or your product during these times, it's evidence that you have, you know, product market fit. You have something. You're solving a relevant problem for your user and your customer, and that's going to resonate with investors. And we're going to talk a lot more about this particular issue when it comes to paying customers. Okay. So what are venture investors doing during this time? Okay. They're looking at new investments. So they're looking for quality deals with experience management. Again, these are where the winners are picked. Venture knows that this is where this is the times in which unicorns are built. And so they're going to be actively still scouring for opportunities, okay? Number two, they're supporting portfolio companies. So obviously the ones that they have invested in, they want to make sure they support their existing winners, okay? So they'll allocate a certain amount of their fund or allotment of capital towards sustaining runways for those companies. Lead investor conviction. So they're gonna look at signaling the market. They're gonna say, are companies getting outside capital from fresh investors, or are internal investors, existing investors investing in these projects? Active communication, so they're constantly talking with entrepreneurs, they're constantly talking with their existing portfolio company entrepreneurs. So this is a good time to engage with venture capitalists and investors, because when things are hot, they'll never return an email. Right? Very difficult if you don't have a warm intro with them to actually engage and have, meaningful conversations. This is actually a time in which they want to talk to people. They want to get a hand and the pulse on the market. They want to talk to entrepreneurs. runway. They're looking at companies. They're helping companies on extend long runways and help maximize efficiencies with their capital. Line of sight. I say line of sight is they're looking for realistic and measurable milestones and outcomes from entrepreneurs. So if you are if you're doing a drip campaign to a couple investors, sending them email updates or whatever, they want to see milestones. What are you doing? What are you doing the last month when this happened? The last 3 months? They want to know that it's realistic, and they want to know that you have these goals that you're gradually hitting. And they're always, searching for unique terms. So, they want to maybe get some seniority in the capital stack. They're going to build in some terms in their term sheets potentially with investor protections. And this is where they're getting really creative in terms of how they're engaging with, potential deal flow out there. Okay. So what should you as an entrepreneur do? Number one, stay calm. You got to stay calm and carry on, right? Yes, a lot of you think that the shit has hit the fan, but right now is a good time, based on kind of what I explained and talk to you about, to signal yourself and to stand out above the crowd. Okay, so one is tap into existing investors. If you have existing investors, this is a good time to constantly have dialogue with them. Right, your best source of capital right now could be your existing investors, because the existing investors they want to protect their investments, right? They want to make sure that the companies that they invested in are continue to be successful, and they understand there's going to be difficulties and challenges, and so that is probably your lowest hanging fruit. Now, if you haven't raised any capital and you're just going through your roadshow initially to do your pre-seed or your seed rounds, then there are some other things that you got to do. So seek partnerships. Partnerships is great. This is an opportunity to embrace competitors, right? If you have competitors that you know of or have arm's length relationships with, this is a good idea to come together and band together to seek if there's a way to come to kind of join forces in some degree, okay? Or to do some revenue sharing or revenue in order to weather the storm. Communicate, strategize, and pivot to launch and lead. What is that? Talk to your team. Talk to your internal stakeholders, your external stakeholders, being your customers, being investors potentially. Internal stakeholders, so important. Talk with your current team, your current partners, your current vendors. Strategize with them, because everyone's in it together, and try to launch your product. I tell a lot of companies that this is the best time to launch your product. Test the market, right? And then the last three things I'm going to talk about kind of moving forward is doing the financial planning, getting your finances in order. And that's knowing your finances, which is understanding your business from a financial lens. A lot of companies, a lot of startups, one of the things that they neglect the most is taking care of their finances. Now, if you're a startup and you don't have much finances in terms of you don't have revenue, you're pre-revenue, you're managing some of the costs. One of the things a lot of the startup entrepreneurs in those shoes, they need to do is start looking at and building your financial models, right? That's one easy area people neglect, because a lot of people just don't want to deal with spreadsheets. They don't want to deal with the numbers, they want to work on product. They want to work on the sexy things, like talking to customers, working on strategizing. But the finances tends to be neglected. So I want to talk a little bit about that today in kind of the second, the second portion of our discussion here. Reducing burn, and the most important thing I put on here is prove out revenue, right? Prove out revenue. Yes, it's hard in crisis time in which customers aren't engaged. They're not spending money. How do I get customers to engage? And so these are some questions that you and your team have to work out now, and understand how to pivot. And I think some of you had joined a session yesterday about pivoting your strategy. But today I'm going to kind of talk about financial modeling, and then talk about a topic that a lot of people have been asking me. My team, we struggle with and examine all the time, is revisiting your revenue model. revisiting strategies in which you can come up with the best and most frictionless ways to monetize your business. Okay, so financial planning. What's financial planning? Financial planning is basically the process of determining how your company will achieve its vision, strategic goals, and objectives. Okay, pretty simple. So it's different from accounting. FP&A is kind of like this, big corporate America talk, but I'm just going to talk about financial planning. It's planning out your finances, planning out where your money comes in and where your money goes out, right? Accounting looks backwards. Accounting looks at historical information. So you're trying to do things in terms of tax implications, looking at P&L statements, how much income did you make, how much revenue came in the last 12 months, what were your expenses the last 12 months. That's accounting. FP&A or financial planning is forward looking. Okay, it's understanding your business through a financial lens, and that encapsulates two things we'll talk about today, which is which entrepreneurs need to do today more than ever, especially when you have more time on your hands, is engage in financial modeling, understanding your business, and then make sure you're doing capital budgeting, right? Managing your cash and managing your capital. So what's the P in financial planning and FP&A? Financial planning and analysis. That's what FP&A means. So P is, here's some of the questions that you should be asking yourself. What are your gross operating margins, right? How much money am I making? How durable is your stream of profits? What are the variables that go into determining price and product? So we'll talk about that when we look at revenue, when we look at, revisiting your revenue models. What are those levers that impact your revenue? What are your fixed and variable costs? When we talk about managing burn later on, we're going to talk about, understanding what are your fixed expenses, how do you reduce those, and then ultimately how you mitigate some of the variable costs that go into eroding your contribution margin, which we'll talk about that. What assets are used and will be used in business? Okay, are you a heavy inventory related business? So you have to use the inventory assets actually to convert into revenue. How many months to break even? How many months to reach cash flow positive? When will you run out of cash? Right. This is a very important question. Companies who've raised a little bit of money need to understand how to stretch out their runway. Those who haven't raised money, you're probably supporting your startup through bootstrapping. So you probably got some personal loans. You probably have a few $1,000s, a few credit cards maxed out. Okay, how is that money going to sustain you? Okay, and then can you foresee any challenges, any changes in cash flow as you grow? The A in FP&A stands for analysis, right? So this is analyzing your business based on some financial implication. You're not looking at hard numbers per se, but you're looking at strategy around your business. So how long does it take to get a customer to buy your product? What does the sales cycle look like, right? What is that the sales cycle? Some of you guys might be in a B2B business in which you're selling to enterprise. That may take 6 months of a sales cycle to convert, right? You may be doing B2C online, and that may be, your sales cycle may be super short, okay? Understanding the cost behind the sales cycle is important. How much cash do you need to get to the next milestones? Hopefully, you've been, as Bixelites, you guys have been attending and really digesting all of the things that, your advisors or, some of the workshops that you've attended have been talking about OKRs. Knowing and constantly working with your teams about your objectives and key results and setting these milestones. Do you need cash to reach some of these milestones? And if you do, how long is it going to last? How much you spend on marketing to generate revenues, right? How long will it take to convert prospects into paying customers? That's important. And ultimately, what are managing your customer acquisition costs? That's super important, especially if you're fundraising. I mean, right now, investors are ultra sensitive to your CAC, your customer acquisition costs, right? And one thing that I really hone in on all the time is this last bullet, or what are the channels to optimize your customer acquisition cost? So understanding what channels are. If you're a D2C company or selling a direct-to-consumer brand, right? Are you selling online? If you're selling online, what are the costs to your acquisition costs? Are you running Facebook ads? Are you throwing money down the drain on Google AdWords, doing direct to marketing? You doing, social media campaigns? What are your other channels? Are you selling on, Walmart? Are you selling on Amazon? What are the costs of acquisition there? Understanding those channels and understanding the cost within those channels is super important. Managing burn. These are kind of some tidbits that I've kind of thrown together for entrepreneurs to really kind of get a grasp in terms of, managing the day-to-day. So hire when you have direct need or a bottleneck, okay? Entrepreneurs need to be extremely resourceful in general, but in times of crisis, you need to be exceptionally more resourceful, meaning you need to know how to get work done and delegate tasks in a meaningful, in a cost-effective way. So if you don't need to hire, you need to look at all of the tasks that you're engaged in, and if you have employees, if you have contractors, whatever it is, and determine what are the most meaningful tasks and what those costs are. And then do some geographic arbitrage. What I call geographic arbitrage is understanding how you leverage, platforms like Upwork to get things done. Like some of the best entrepreneurs, I've used Upwork and Elance. I've used it since the dawn of time in terms of leveraging really, really good talent remotely, and at very low expenses, right? So I have a whole cadre of bookkeepers overseas that does books for one of my companies, and they're exceptional. They went to school and training for accounting, and they're happy for the work that I'm providing them, but they're able to work at much lower rates than me hiring a bookkeeper or an accountant here, for example. This is just an example. Maybe you can outsource some of your dev efforts or product development. A lot of ops work can be done. I always encourage entrepreneurs to look at potential leveraging, like these type of platforms to help with sales. Like if you're engaged in high level sales, like if you need to be the person closing sales transactions, you need to be in the front lines. But maybe hire people to do some telemarketing to increase your open rates, or to do initial opening calls. Maybe you need to hire people to do your customer outreach when it comes to social media management, or someone just to manage your drip campaigns on SendGrid and MailChimp for your email marketing. Like leverage those resources. That's what it's called. That's why I call it geographic arbitrage. Okay, really good ways to lower your cash burn there. Hack together solutions, right? This is when entrepreneurs have to be really crafty and scrappy when it comes to building out your product, right? Can you launch a product just by putting some things together? It's not going to be the perfect product, right? It's not going to be your MVP, but in times in which you need to reduce your cash investment towards your product, are there ways that you can get this to the customer to validate some of your assumptions and your hypothesis to show investors, can you hack things together on the cheap? Okay. Be prudent with money traps. Okay. There could be a lot of things that trap you into paying, spending a lot of money. So one very prudent thing to do is to build a list of all your subscriptions, right? We live in a subscription economy. We're subscribing to, FreshBooks. We're subscribing to multiple accounting software. We're subscribing to, multiple task management tools, Asana and Trello and God knows what else. We're subscribing to all kinds of communication tools. It's time to consolidate. One tool may be able to consolidate, and you may not have all the bells and whistles, but one tool may be enough, and you can get rid of some of the other tools for now. Right? So think about those type of things. Prioritize what your expense is, especially on software and subscriptions, and start kind of tightening the belt there. Put conservative buffers and contingencies in your planning, which is, if you have allocated budget for a certain project or a campaign or product, whatever it is, make sure you have good buffers. You know, if you can't, if things don't, basically your cost overruns, right? If things go over budget, make sure you have some buffer to put in place. Track your expenses carefully. Reduce venture debt. This is very important. A lot of people are looking at debt as a way to supplement their cash flow. So I always, you know, you always want to ask yourself, do I want Uncle Sam, or do I want Bank of America? Do I want Citibank to be on my cap table, right? Debt can help companies, right? Because sometimes debt may be cheaper ways, cheaper sources of cash, okay? But the danger with debt is whether you're making money or not, you have debt service. You have to pay someone back. And so that could be the detriment and the downfall of many companies when they're oversaddled with debt. And debt could mean credit cards. That could mean a personal loan, right? And we live in a time in which I'm sure you've gone on to a lot of kind of seminars by Bixel and SBDC and whatnot. There's a lot of, you know, available, you know, disaster relief loans and SBA loans and things of that nature. And a lot of those are great because they're very low debt service, because there's deferments. There's, you know, zero interest loans the city of LA is doing and other municipalities are all getting involved with. So look at those carefully. Create a budget and sensitivity analysis. I think that's really important. So budget out what your expenses are. Okay. What do I need this month? What do I need the next 3 months? What do I need the next 6 months? And then create a sensitivity analysis. For those of you guys that don't know what that is, it's basically, it's a way to look at your budget and or your projections by creating basically like 3 buckets. You can create more buckets if you want. 3 buckets. One is a realistic point of view. One is worst case scenario. Worst case scenario is this is going to cost me more money. My runway is going to be shortened. Best case scenario is, okay, if I can do some of these things on the cheap, I can extend my runway. Look at all of these, and then, you know, then you can be able to calibrate where you are. This is kind of like a runway chart to show, okay, financing sequences from if you're a C, you're trying to raise a Series A to Series B, the average elapsed time before you run out of cash, medium, and hypothetical best practice in terms of how much runway do you need in between fundraising, right? So we're seeing 18 to 20 months. You're always hearing that as a benchmark, and this is one I pulled through Crunchbase as kind of like a best practice that a lot of entrepreneurs are focusing on, right? If your runway is 3 to 6 months, like you're probably not going to weather the storm. Like you need to make sure you can drive things further out. I got a lot of other things to talk about, but I'm going to kind of run through this because I'm kind of butting up to our time frame. How much time do we have, Elaine?
11
or
yeah.
11:15? 11:15. Okay. So let's revisit the revenue model. A lot of people are talking about this. A lot of people, you know, are saying, you know what, I need to figure out, you know, ways to pivot around our initial revenue model and ways to monetize. So there's a lot of text here, but I'm just going to talk through this. Revenue model is basically a system in which a business monetizes or derives financial gain from its products or services, right? And I always say this is one key component. I say it's a way for a company to make money and establish economic sustainability. You have to sustain your ability to make money. Like I can throw up a lemonade stand in my front yard. That's a revenue model. I'm making money. Like, but is it sustainable? Am I going to run a lemonade stand like every single day? No, it's temporary, right? Or, you know, so how do you sustainably create a revenue model that's going to help you, you know, drive revenue? So the importance of a strong revenue model isn't, again, direction, clear-cut financial sustainability. It sharpens your business objectives and direction. You determine the business viability, the strength of the business model, and the pivot points. You guys understand that there's a difference between a revenue model and a business model, right? A lot of people think it's one of the same. A business model is just how you obtain customers, or what your how do you grow, how do you, not necessarily how you make money. Revenue model is how you monetize, how you create sustainable path towards revenue. And I talk about this now in the context of fundraising, because we talked about fundraising outlook, how do we raise money. So today I'm talking about not just financial planning as best practices to manage your business, but also financial planning in terms of creating optics for your company in the context of fundraising and appeasing investors. Okay, and investors right now are very focused on revenue. Are you making money? Do you have you had proven techniques to derive paying customers, right? And then we'll talk about all these other things. But one of the key thing I want you to get at is determining business viability, right? Some companies, once they revisit their revenue model and have conducted some experimentation, they may come to the realization that like their business is not really viable, right? And that's okay too, right? Like the reason we go through this exercise and doing financial modeling is not to show how great of a hockey stick you can build your company. It's really to create, to derive some truths for you. Because when you're in your entrepreneur bubble, when you don't have yes people around you telling you how great your idea is, how awesome, how great of a project, how great of a company you're going to build, you have to sit in front of the mirror by yourself and say to yourself, like, is this worth doing? Without people telling you and patting you on the back, right? Because all of that is like false feedback. You have to look at yourself in the eye, look at it from a financial lens and a point of view and say, is this business viable? Are the unit economics worthwhile for me to continue this business, right? And that's really important. So revenue model rules. Shortest distance between 2 points is a straight line. We know that, right? So we need to ensure that the path between you and your customers and cash flow is as frictionless as possible. I've seen very complicated strategic revenue models, like you go down this path and, diagram and doing this and through this partnership, whatever. And then you go through this long labyrinth of explanation to derive how you make money. And investors don't want to hear that. Investors want to hear that from A to B, you have a very simple way of deriving revenue, right? I have this product, it solves this problem, they buy it easily through this platform, and that's it. So your revenue model must be frictionless and easy to explain. Keep it simple, stupid. The KISS method. Make sure your revenue generations are easy to explain, right? Overcomplication, I put, is it creates a barrier for money, the front end and the back end, meaning it's hard for if your employees have a hard time digesting it, it's going to be hard for your internal stakeholders to digest, and certainly your external stakeholders like investors and partners. I'm not going to go through revenue models because there are different revenue models here. Subscription, what are the pros and cons? Advertising, transaction, licensing, whatever. You guys can go that on your own. I'm sure you guys are well versed in that. I want to talk about the revenue drivers. This is very important for entrepreneurs to understand, okay? I throw some quantitative stuff on here. I'm not trying to get all, academic or anything like that, but this is just to hit home some points for you as an entrepreneur to understand your business from a monetization standpoint. Your revenue is basically a factor of these four things, right? Customers, price, transaction, and frequency. And certain companies are going to be more sensitive to one or more of these levers than other companies, right? So when you look at your revenue, it's a compilation of your customers, the number of customers. The more customers you have, you're going to have more revenue, right? Your price. The higher the price, you're going to generate more revenue, right? Transaction, the average volume or transaction size, okay? The larger the volume that your customers purchase, the more money you're going to make. And frequency, the rate of purchase. How often do customers purchase? Do you have a continuity program? Do you have affiliate or referral programs? How do you generate and yield a K factor, which is the coefficient of virality, right? How do you optimize your K factor in your virality in order to drive down your user acquisition costs and increase frequency of purchases? So this is your revenue driver. Some companies don't have that much sensitivity when it comes to number of customers. You may be a B2B company selling a high-priced enterprise solution. You don't need tons and tons of customers. You know, you may survive and do very well with 10 customers a year. So therefore, the number of customers, your business is less sensitive to the number of customers, right? But it may be more, less sensitive to transactions, but it may be very sensitive to price. So therefore, you need to optimize your price because you're a low volume based business. You need to your revenue is going to be optimized. It's going to be sensitive to how you price out your product, right? If you're selling a commoditized product online, you're selling really cheap widgets, for example. Well, the number of customers, you're going to be super sensitive. The frequency of purchases, you're going to be super sensitive to, right? Your sales price, probably sensitive to when it comes to your competitive landscape analysis compared to other competitors. So understanding the drivers is super important, and it's basically comprised of these three things. So do some deep dives with your team about this and understanding how you derive this. Let's see what else. Don't look at this chart, doesn't matter. Ways of maximizing your profits. There's two ways to maximize your profits, right? One is lower cost. If you lower your cost and your price is constant, you're going to make more money. You're going to profit. You're going to maximize your profits, right? But if you're, and a lot of companies are doing that right now. In times of crisis, they're looking to lower their burn. They're looking to reduce costs, create efficiency. If you keep your costs the same, in order to maximize profits, you can increase price. And this is where the trick is. How do you increase your price given your message to the consumer, right? So, there's many ways to do cost control, but understanding your customers are willing to pay, I think, is really important. How do you justifiably get your customers to buy more and buy at a higher price? And brands who do that do very well, right? They position themselves in a way to maximize profits. And hence, your revenue model basically will help dictate your pricing strategy. So pricing is very important. I think Ed is one of our advisors that's on the call here, and he's a pricing guru, right? A lot of companies have gone to him. He's done a lot of workshops on pricing. So understanding pricing, knowing how to A/B test your pricing, knowing how to do customer discovery, and understanding pricing sensitivity, elasticity of your pricing is all super important, and it's well aligned with your revenue model. I won't go into this. I think you guys talked about this maybe. Value. When you're talking about creating revenue for your customer, you're thinking about, okay, what problems am I solving, right? How do I derive revenue to the customer? So a lot of people talk about value. Value is such a huge buzzword. And a lot of people don't even know how to define value. Well, I dumb it down into a very simple equation. It's quality over price. That's the value that you bring to the customer. Quality over price. How do you increase value for a customer? You increase the quality, right? You keep the price the same. If you're selling a product at the same price, you increase the quality. If the quality is the same, you lower the price. Simple. Those two things, a denominator and a numerator, will help you understand how you create value. So you can reduce price by reducing costs, et cetera, but how do you increase quality? That's the important thing. And hopefully you can read through this a little bit, understanding the customer's feeling of using the product. What are some tangible aspects of the brand that you bring to the table? Customer satisfaction, all these type of things. How do you resonate to the customer for them to feel that you have a high quality product? Okay. So pain point value. Okay, so we talked about that. Unit economics. This is really important when we're talking about financial planning, right? Understanding your break even. So if you know, the outflows and the inflows of your business. So if you're investing in if you have a financial cost, you divide that by what your margin is, right? Your sales price minus your variable cost is what we call the contribution margin, right? It's your margin that you make. You divide that. You divide your fixed costs by that. If you're investing in a campaign, if you're investing in assets, if you're investing in equipment, if you're investing in inventory, this will give you an idea of what your break even is on those type of investments. So it's important to do that type of analysis. The general unit economics in a digital type business is CAC versus CLTV, right? Your acquisition costs versus your lifetime value. So how do you reduce your customer acquisition cost? Viral effects, increasing your K factor, affiliate, giving referrals, right? Inbound marketing, freemium, free trials, touchless conversions, channel marketing, strategic partnerships. Those all drive down your customer acquisition cost, right? How do you increase your lifetime value? On the bottom right, recurring revenue, scalable pricing, right? Understanding your pricing models, pricing line extensions, offering and differentiating your prices. This gives your customers more motivation and incentive and services and product to continuously engage with you. And then, the opposite, obviously, increasing your costs would be field sales and engaging in activity that doesn't yield ROI. And then driving down your LTV is, high churn rates, low customer satisfaction, low engagement with your customers, these type of things. So forecasting, I think there's a couple things that I want to talk about before we wrap up is, the last thing I want to leave with you is forecasting. As an entrepreneur, right now, you're incarcerated at home, you're doing a lot of things, but you have a lot of time on your hands. One of the things that you guys should be doing is working on your financial model, right? Working on a model, obtaining a model that you can play with your assumptions and try to forecast out what your projections are over the next 2-year horizon, 3-year horizon, maybe 4 to 5 year horizon. It's important for your business, number one, so it kills 2 birds with 1 stone. It's important for your business for you to understand, again, your business from a financial lens. And number 2, by going through this exercise and doing that homework, it helps you be able to convey your business financially to investors better. And investors right now, more and more question and want to make sure that entrepreneurs understand the cost of their users. Why do you think you're going to get 10,000 users by next year? How did you come to that figure? How do you figure that these costs are going to be mitigated? So investors are going to be asking all these questions, and you need to understand how to do that. Okay. One way to do forecasting is there's 3 ways. I'm going to talk about the first 2. One is top down, and the other is bottoms up. And for those of you I talk with a lot of entrepreneurs. They'll have a financial section in their pitch deck that says, okay, the size of market is X, and this is what we're projecting over the next year, 2, 3 years in terms of our customer acquisition, in terms of our revenue. A lot of times it's a top-down approach, right? The size of the market, this is a $50 billion market. If I get 1/10 of 1% of this market, I'm making this amount of money. This is great. Come and join us and come along for this awesome and profitable ride. Investors don't want to hear that. Investors don't want to know that you literally just took some large market number and then arbitrarily picked some small percentage that you calculated against that, and then that's what you use as your baseline forecast for your users and your revenue. The best way to do it is bottoms-up approach. The bottoms-up approach is a more methodical approach, and it shows investors that you truly understand your market, truly understand your customers, and you truly understand the conversion rates within your industry. So the way to do that is you look at average conversion rates in your industry. You look at average click-through rates on ads in your industry. You look at campaigns in your industry and how it yields customers, and then you put it against your budget.
I'm going to spend $10,000 on this campaign. I'm going to spend $20,000. I'm going to spend $50,000. And then you calibrate it with those industry benchmark numbers, and then it's going to generate users for you. It's going to say, well, if you use industry benchmarks and aggregate it to a budget that you put in, it's going to say, you're going to be able to yield 2,000 customers, or it's going to be able to yield 500 customers, or it's going to yield 5 customers. And from that, you're going to apply your price and generate a revenue, right? This is the best way to do it. One, because it shows whether your company's worthwhile pursuing. If you're going to spend a lot of money converting at industry conversion rates, that most of the time you're probably not going to be able to reach. But assuming you do reach those industry conversion rates and be able to achieve those industry conversion rates, it may yield you a customer number that may not make the business worthwhile. You're like, what? I'm going to spend this amount of money and only get these amount of customers, which equals this amount of revenue. Like, okay, something's fishy here. I need to pivot my revenue model. I need to pivot my pricing. I need to pivot my business, right? Or it may be pleasantly surprising to you. It says, wow, with this little bit amount of money, I can get this amount of users. Okay, now I have a narrative that I can craft up to talk to investors. And this is what investors want to engage in. This is how they want to talk with you. So here's, I do a lot of financial modeling. I help a lot of, Bixel clients with financial modeling, understanding their revenue assumptions, their spends, their outbound marketing, their unit economics to come up with, how do you acquire customers? What do all those numbers look like when it comes to achieving numbers? And then what does it look like in an income statement, okay? How did the total sales and product revenue and ad revenue, what does that look like with realistic numbers? What's the cost of acquiring a customer? What's the cost of sales? What's the cost of revenue? And then operating expense. And you can forecast out your income statement and then eventually your balance sheet and cash flow. Okay. If you guys have any questions, I'm happy to, work with you individually, or, you can talk with Kat and Elaine about how, I can understand your business a little bit. You can come to co-working days. We have great advisors and mentors that help you craft these things up. But this is a really good time to hunker down and focus on your financial modeling and understand this business financially, because it's going to be challenging to raise money, no doubt about it, in this environment. The more prepared you are, the more prepared you are to visibly show investors that you've done your homework and that you can portray and exhibit how well your business looks financially, the higher the probability and the greater chances you have at successfully convincing investors to raise money. So this is kind of a revenue chart of some companies that have gone through and their pivots. I just kind of threw it on their Airbnb, how they pivoted several times their revenue model in order to kind of find their sweet spot. This is my revenue mantra. The 6 R's. Revenue requires regular review, revision, and refinement. So right now is a great time for you as a team, as a solopreneur, whatever it is, to revisit your revenue and determine if your monetization tactics work. And the way to do that is to start working and crafting your financial model. That's it for me. 11:14. We just hit the mark. So I don't know, Elaine, do we have time for some Q&A? Oh, by the way, here are some startup tools that you guys can use that I threw in here for helping you manage some things. So obviously QuickBooks for accounting, there's Xero, which is a great accounting tool. Float is a great way to kind of manage your expenses and organize your cash and your burn. Expensify is a good tool to manage all to keep track of all your expenses. Free Agent is a burn tool. Gusto is another, payroll and admin tool. There's a lot of good financial modeling tools. I like to, I built so many financial models over the years, so I have, various ones for various types of businesses and industries, you can reach out to me. I'd be more than happy to kind of craft one for you. There's several online that you could look at. One that's relatively decent is called Startup Financial Model. So I don't know if they have kind of a freemium approach. I think they do. Feel free to look that up in terms of, getting started with using some sort of online platform to help, build your financial model.
We can do, we have a little bit of time. If people that are still on, if they want to ask any questions, we can do like 10, 15 minutes of questions if anybody has questions right now.
Yes.
Question.
Go ahead.
I would say before anything else happens too, I dropped in Emily's email once more, but if you want to schedule a one-on-one session so that, as Jay mentioned, that you can do, he can go over your particular, go in depth with your company, please schedule a session with Emily. She can help you guys arrange a session. We do ask for updated OKR, so I will, I know Jay mentioned that, but we can go ahead and ask questions now. So,
do you mind if I start? Hi, my name is Quinny Lynn, and thanks so much for the presentation, Jay. I run a social impact consulting firm, and I'm building a software that's going to try to make pregnancy safer. So it's going to be a health tech company. I'm at the pre-revenue stage. It's still in some ways an idea stage. And just listening to your presentation and thinking about building financial models, I think the challenge that I have is that all these inputs that you were talking about, because the product hasn't taken any form, it's hard to know whether this is going to be B2B or B2C, and then what values to assign. And I think that's what I've been struggling with. And I've been told not to put in my pitch deck multiple go-to-market strategies and business models, because that would look like I'm indecisive. But that's where I'm at. And then, and so I was wondering if you had some input on that. And then secondly, what did your MVP look like before you pitched to investors to raise your pre-seed? Because I'm trying to, I think it all looks very different, and people say you have to show value, you have to create something, but I'm struggling with that, what that is that's sufficient for the investors that you're trying to approach. Thank you.
Thanks, Queenie, for your question. So your first question is about your input. So I think the sensitivity analysis is really important. You should build multiple versions of your financial model. So if you're experimenting with either pursuing a B2C or a B2B route, and I see that in a lot of companies. A lot of companies have, ways in which they can sell to enterprise and optimize and capitalize on revenue that way. Or take a B2C approach, try to target consumers and circumvent any intermediaries and go directly to the consumer market. My approach is the only way you're going to determine if it's viable is if you financial model against each other. So create a financial model that is based on approaching it from a B2C standpoint. So your inputs are going to be different there, right? You're going to have inbound, outbound marketing costs. Your marketing costs are going to be different, right? You may be running ads. You may be doing a lot more consumer type of campaigns, and those costs are going to be different. So you're going to have to factor in those costs. If you run a B2B model, your user acquisition costs may be much lower. So you may have partnership and affiliate type of commission-based expenses. You may have BD expenses because you may hire someone to do BD or sales. So your user acquisition costs will be a little bit different there. So I think create separate models, and the models will tell you what it looks like. And the model will actually, kind of give you some insight into what's more attractive to target. And it's also going to tell you what resources you have. Because as an entrepreneur in any business, you have to look at your core competencies, skill sets, and resources, and determine how do you leverage those in order to make a business successful. If you don't have certain resources, competencies, and skill sets, then you need to get those from third party. You need to recruit co-founding team, whatever it is. You need to make sure you match that, right? So running two models, I think, or multiple model against each other is what's really important. And to your question about like the inputs, I think that's a really challenging thing for most people, because a lot of people say, financial models are literally BS. You're just throwing crap on the wall and seeing what sticks. And yes, for the most part it is, because what you're doing with a financial model, you're trying to craft a story to the investor that, look, this is worthwhile investing in, right? But besides the one you share with an investor, which has its smoke and mirrors, you need to do one internally for yourself. That's, again, showing you the realities of your business. And the inputs are hard. Sometimes, like, you can't find assumptions. I tell people, go on the internet and find comparable numbers, comparable industry conversion rates, comparable click-through rates with other competitors. If you have like incumbent competitors who are publicly traded, for example, download their 10Ks, their annual reports, the initial 10Ks years and years ago before they went public. Look through those, because it's going to give you a lot of insight on their conversion. It's going to give a lot of insight on what inputs you can put inside your inside your assumptions. Your second question was about MVP. I think the MVP question is different for everyone, because everyone launched at different stages. I consider an MVP something that you can go engage with customers with, right? Some people may think, oh, MVP is something that you actually go out there and collect money. There's so many different types of definitions circulating out there on the ether, okay? Is it MVP? Now it's like MRP, the market ready product. Is there, most valuable prototype? Is it a product or a prototype? Like, okay, forget all that. The bottom line is, can you hack together a product that you can actually go out there and start engaging with customers and determining if customers will talk with you, and then ultimately try to see if you can convert some paying customers. I think that's, at the end of the day, that's the life cycle of that development. So hopefully that kind of answers your question a little bit.
Thank you so much.
Thank you, Jay. And I think Allison had a question.
Allison?
So we'll let Allison.
Perfect. Hi, Jay. Thank you so much. This has been absolutely fascinating and fantastic. I really appreciate it. So my question is similar to Quinny. I do consulting work, and my product is my time, right? So I'm selling my time, and I have some IP and a digital asset that I will be having to optimize my time. But when we're talking about services and financial modeling and financial planning, I don't really hear that often, right? Our time is finite. There's only so much of my time I can sell a week. So how do we look at that different than selling a product that, I know you're in the e-commerce space. How do we go about those kinds of differences? There's only so much of my time I can sell per week to a user, right?
Yeah, so that's a good question. If you're running like a consulting firm or something, you're obviously leveraging headcount, right?
Right.
Your product is people. So
right.
You're arbitraging, the amount of money that you're paying versus the amount of money you're collecting for services for your consultants.
Right.
So I do have another digital platform that is service-based. It's an online delivery platform, and it's very labor intensive. Basically, the product is labor. So I'm leveraging basically like wage arbitrage there. So if you're just running a consultancy kind of on your own, then I would do a sensitivity analysis based on client acquisition.
Okay.
How are you getting clients? And at some point, you're going to reach a kind of a ceiling, right?
Right. Right.
Only so much, like your profit maximization is going to be the amount of hours in a day Allison has. So,
right.
On a best case scenario, your ceiling is going to be Allison working 24 hours a day with no sleep and engaging with customers every step of the way. And, and you charge X amount of dollars for your services. That's basically the ceiling of your business.
Right.
So you would run a sensitivity analysis on that, and then how do you scale that? How do you scale that? Do you, if you were to reach that ceiling, how would you grow your business? Would you hire additional consultants? Would you offer maybe another product that's, you know, instead of one-on-one consulting, you do two-on-one consulting.
Right.
You know, kind of take like the karate dojo model or
Mhm.
the CrossFit model, right? Like if you're maxing your revenue with one-on-one time, how do you reduce your rate and do two-on-one time or do
Right.
group consulting? Okay, it's like so this is a good point, Allison, what you're bringing up, because if you understand your ceilings and understand what the drivers to your revenue, which we talked about earlier, then you can understand how to grow and pivot your business and
Right.
what services and product offerings that you can start diversifying.
Right.
So now you can say, okay, I can grow this business by offering other service lines,
Mhm.
or other product lines.
Right.
And create a menu of services that you can create now to scale and exponentially grow your revenue. And then you throw that back into your revenue model and say, okay, if 60% of my time is doing one-on-one consulting and 20% of my time is doing two-on-one consulting with this type of price point, now you can compare and see, oh, I can actually make more money doing 80% of the work.
Right.
And then now if you offer three-on-one consulting or group consulting or, do some other, like webinar type stuff,
Right.
pre-recorded and archived, and you sell those archives at a much cheaper rate. Now you're proliferating even more product lines, and now you can optimize your revenue capabilities based on your single person solopreneur's time, even more. See what I'm saying?
Yeah, absolutely.
Yeah.
Cool. Thank you so much. Thank you. I really appreciate it.
All right, awesome. So just as a reminder, I'll be sending out the PowerPoint as well as the recording of this webinar. And I think if you guys have any, like I said, if anybody wants to schedule a one-on-one, please reach out to Emily and she can help you guys coordinate. And other than that, if you guys have any more questions or thoughts, please let us know. Again, scroll up if you guys want to see the Slack channel. And then I know Kat dropped in a few resources of people that are doing things. And then anything else that we can help you guys with, please let us know. Other than that, reminder, we have another stand up tomorrow with Lizzie, who's going to talk about maximizing your time while working from home. And Thursday is co-working day. So if you haven't signed up for co-working day, do sign up, because only the people that RSVP ahead of time get the link to actually schedule a one-on-one meeting with advisors. So if you haven't done so, please RSVP to co-working day. And again, I'll send out all the links. If you're on the Slack channel, then you guys can also access them on there. But other than that, that should be good. So thank you everybody for joining us, and we'll see you all tomorrow. Thank you, Jay.
Thanks, guys.
Thank you, Jay. That was awesome.
Thank you, Jay. That was amazing.
Yeah.
Bye, everybody.
Bye, all.
Bye.